everyone. Sat here with Adam Burniston, lead portfolio manager for the MPS range at LGT. We're going to have a reflection of markets in 2025 and an outlook for 2026. So, Adam, good to see you again.
Yeah, you too.
So 2025, Adam, I mean, characterised really by pretty strong returns across the board, market-wise.
Yeah.
What were them, if you're reflecting back on the year, how would you really characterise what we went through last year?
So I think we saw a very welcome broadening out. So over the course of this video series, we've been talking each quarter about what we're doing in the portfolios, and for the last couple of years we've been overweight Asia and emerging markets, and generally they've maybe not done as much as the US. The US has been the focal point for the last few years. What was really pleasing last year was this broadening out of returns. So actually by the end of the year, the US had been outperformed by Asia, emerging markets, China, the UK and Europe. So this is something that we've been positioned for and excited about really for a long time. So I think the big story in equity markets has been that shift in leadership.
Yeah, we have done a number of these podcasts over the last year or so, and it's been a constant question I've been asking you: have we seen any broadening of returns away from the Magnificent Seven? But really, I suppose, when did that start kicking in last year? When did we start seeing the wider market start delivering returns for us?
Yeah, it's a good question. I'd say from summertime onwards, it became really, really stark. So we bought Japan a good few times last year, just increasing the exposure to Japan. And even the last slug of it that we bought in August, July time, even that is up kind of 15+% at this point. So really the second half of the year, a lot of Asian returns coming through. The first half, Europe was by far and away the biggest performer. It seems a long time ago now, but if we kind of hark back to last March, Trump had just taken office, announced all of these tariffs, and investors really refocused on Europe, thinking, okay, they're not going to support, the US doesn't want to support us militarily anymore, defense. We really need to rebuild our own infrastructure and everything. And that really kicked off the rally in Europe. But yeah, the second half was Asia focused.
And are there any particular industry sectors that we're seeing stronger returns in than others? I mean, for example, my guess would be that the retail consumer part of the market is still relatively weak compared to the broader market. Would that be right?
Yeah, of course. And even in these regions that we're talking about, so Asia, for instance, the Asia index that we bought, it is becoming very concentrated. Samsung, TSMC, Taiwan Semiconductor, and a firm called KS Manufacturing in South Korea. All three of them make chips for AI and for computers. And they have really, really seen their share prices explode, and they've become a big part of the index now. So that has been driving returns in Asia. The same is true in the US, where the Magnificent Seven again has outperformed broader US equities. But actually, we've seen quite a different state of affairs in Europe and the UK, where it's been more cyclical businesses, be that banks or miners, manufacturers. But as you say, I think it was at the last quarter we discussed it, that consumer goods still doing pretty badly, as your average consumer spends less.
Yeah. Now, obviously, inflation plays a big role in market performance. We've seen inflation soften across the board, really. I mean, what impact has that had on markets?
Yeah, I mean, we got quite excited at the back end of last year as inflation started to come down, because of course when inflation comes down, that means that rates can come down, and when rates come down, that makes our investments actually look more attractive. If you can only, if what you can get in the bank, let's say, goes from 4% to 3%, all of a sudden the investments that we hold look even more attractive than they do already. So as investors, we're always hoping that interest rates come down. But what we've actually seen in January is a slight little uptick again in inflation. So in the UK, and really what we need to be conscious about is after a big inflationary spike, historically, you'll get these ripples afterwards. They're kind of like an earthquake's aftershocks. Yeah. And they can last 10 years, 15 years. Now, each aftershock is typically is never as large as the first one. So we had that big inflation shock after COVID. We of course spent, across the world, trillions of dollars in COVID spending, and that caused a lot of inflation. But we're seeing little ripples of it, so that could just push back rates coming down as quick as we'd like. But we are still expecting at least a couple of rate cuts in the UK and the US this year. So hopefully get down into the low 3%.
Yeah, we're down at 3.75%
Yep.
in both the UK and the US as we speak.
That's right, yeah.
And we're expecting rate cuts pretty soon from the Fed over in the US.
Yeah.
And at the same time, we've seen a weakening of the dollar against most major currencies. What impact is that having on the equity markets globally?
Yeah, so that is also something that we were worried about. When Trump took office, part of his approach was, as part of the Mar-a-Lago Accord, was to try and weaken the dollar to make US manufacturing globally competitive again. Now, rightly or wrongly, Trump has got a bit of an obsession with trade deficit. So he doesn't like the fact that they send a lot of money abroad and get lots of goods back. Now, actually, a trade deficit generally is just emblematic of a rich country being able to buy stuff. You send green paper abroad and you get real things back. So any kind of wealthy country like the US, is kind of reasonable to have a trade deficit, but he doesn't like that. So he wants to make the US dollar weaker so US manufacturing can be sold abroad. Now, as UK investors, typically sterling denominated, if the dollar gets weaker and we hold US assets, that makes them cheaper in our book. We're losing money.
Yeah, and on that point, obviously, a lot of the world's leading companies are US based, and there is often a draw towards investing greater percentage of the portfolio into that market. But obviously, as a backdrop to that, you've got the currency exchange rate to take into account. And overexposure to the US can have negative effects on the portfolio.
Exactly. So what we're trying to protect against is the value of the dollar continuing to go down, and then in sterling terms, it looks like our investments are going down. So what we did in November was we put a currency hedge on our direct US holding. And actually, if you look at the one we sold and the ones we bought, because the dollar has weakened, we've made a good few % difference there. So we are looking to protect clients on the downside from that dollar.
And looking more closely at the UK market, last November we had the autumn budget.
Yeah.
What was the result of that? What kind of budget was it really on reflection from an investment perspective? Was it positive? Was it kind of neutral? What would you say?
From an investment point of view, it depends what you're investing in. If you're a gilt investor, taxes going up, making the government look more fiscally responsible, more liquid, actually that gives you a little bit of confidence about your government debt. Let's say I live in America or Switzerland, I'm more likely to lend the UK government money now that I know the UK government is sucking in all this tax, because they're better positioned.
Increases confidence.
And we've seen that actually. So in our gilt holdings that we have in the portfolio, after not doing an awful lot for a couple of years, we have seen a pretty decent price appreciation over the last couple of months. Now, on the other side of things, clearly they've increased taxes across the board, and that could hurt corporations a little bit. Now, we actually haven't seen it reflected in the share price too badly. But clearly what we want in the UK is a very competitive market. We want businesses to start here. We want established businesses to list here. And at the moment, what we are seeing is companies opting to list in the UK. In the US, sorry. So if you're a big European business, a tech business, let's say, you're far more likely to put your company on the New York Stock Exchange when you want to take it public, whereas we'd obviously much rather have it here on the FTSE.
Yeah. Okay. Interesting. Politics. We're not going to address it too much today, but obviously we can't ignore it.
Yeah.
I think it's fair to say that the last 12 months, last year, was characterised by some quite shocking political events. The tariffs, early part of the year, at the beginning of this year, the arrest of Maduro
Yeah.
in Venezuela,
Yeah.
and talk of obviously invasion of Greenland.
Yeah.
Markets seem to have remained quite stable,
Yeah.
even with all of this going on. Why do you think that is? Do you think the markets take Trump seriously, or are they kind of expecting him to back off
Yeah.
a little bit as they, obviously we saw a steep decline in April off the back of
Yeah.
Liberation Day. Then the pressure was put upon him to kind of back off a little bit on the tariffs, which
Yeah.
he did. Markets resurged back. Are markets, do you think, expecting him to act like that on the other moves that he makes, like Greenland, for example?
Yeah, the taco trade, as it's been called, Trump always chickens out. It seems like it's happened again.
Yeah.
In that he threatened the EU with tariffs if we didn't support, or if the EU didn't support his ambitions for Greenland, and he's very quickly backtracked off those. He's obviously kind of talked about a military invasion of Greenland. And actually, what we've seen for the first time, and to kind of come back to your question, is Republican lawmakers pretty much for the first time come out and speak against Trump. And, this is his own party, and actually a delegation of Republicans went to Denmark and just said, look, we're not going to let Trump invade Greenland. Just kind of don't worry about it. So I think the challenge that we're faced with now is ignoring all of the noise that comes out of Trump. Because as you've rightly pointed out, the markets are going up anyway. They just don't think it's going to happen. If Trump invaded Greenland, that's the end of NATO. There would be a trade war between the EU and the US. The EU would probably sign new terms with China, like Canada has just done.
Yeah.
So the US would be completely isolated, and it would be an economic disaster for them. So if the markets, and when we talk about the markets, we're talking about the millions of people doing all their analysis and forecasting in an aggregate, the market is not expecting Trump to get away with any of these things, really. It seems like his own party are willing to block him. Yeah. And that gives us confidence.
Okay. So outlook for 2026. If you're sat there as a retail investor, late January 2026,
yeah,
what can investors really expect from this year? Obviously, we know we don't have the crystal ball, but would you say, number one, the markets are relatively stable? Are the big firms in relatively strong financial positions?
Yeah.
Where are the interesting growth prospects for this year?
Yeah.
And from an international standpoint, are there any particular markets that you guys are really interested in this year?
Yeah. So our top-rated geography at the moment is Japan. We're really interested in Japan. It seems like everything's just fallen into place all at the same time. So Japanese businesses are starting to care about shareholders. Historically, that's been an issue. They put their employees first and then worry about the owners. Obviously, as investors, we're the owners. So that has been a real boon for the Japanese market, the fact that it becomes shareholder focused. The consumer is getting richer in Japan. Their salaries are going up in real terms for the first time in 30 years. They've even got a bit of positive inflation for a country that hasn't had inflation for decades. Yeah. It means that money's moving again, things are happening. And in fact, we might even see rates go up a little bit more in Japan. Yeah. So we score each country, and that's our highest scoring country. The rest of Asia we really like as well. Emerging markets, especially emerging Asia, very, very attractive. And actually, if we're kind of looking at a 10-year basis, you're looking at really strong returns out of Asia over the next 10 years. So plenty to be excited about. In the US, it's a little bit more of a mixed picture. We've obviously got these very expensive AI names. There is a lot of kind of chatter going on in the markets at the moment about whether some of this is getting a bit silly. Some of the really big names, OpenAI, for instance, burning cash, losing market share, losing users, and they have hundreds of billions of dollars of obligations and no profit to back it up. But on the other hand, we're seeing people like Google or Alphabet with their Gemini AI taking leadership. Share price up 80% over the last 6 months. But there is a lot of unknowns. Is AI going to be the revolution that it is? Is it going to be a flop? AI spending last year was one of the a massive contributor to the US GDP and US earnings and corporate spending. And actually, if all of that were to go away, it would be a little bit of a different picture.
Yeah.
The UK is a bit of a mixed bag. Obviously, the UK market was very, very strong last year.
Yeah. Well, the FTSE.
The FTSE, the FTSE did very well last year. On an outlook basis, we are a little bit more of a cyclical stock market. We don't really have the tech names.
Right.
Actually, less than 1% of the FTSE is a tech stock. So ours really depends on GDP growth. We need economic growth to kind of keep coming. And really, if we're seeing rates come down, then maybe that can encourage that to come through.
Okay, fantastic. Well, look, Adam, thanks for the summary.
Yeah.
I think, generally speaking, relatively optimistic about the outlook.
Yeah.
And we shall reconvene at the end of the quarter.
Perfect.
Great
Thanks
stuff.
very much. Cheers.
See you again. Cheers, Adam.